Hello and welcome back to another video. Today I'm going to be covering UK credit scores fully explained. So we're going to go into the full details about what your credit score is and what sort of things you might need to be looking out for if you're looking to improve your credit score. Welcome to the Looking After Your Pennies YouTube channel. My name is Charlotte Jessup and we're going to be talking about all things credit score today. Now, this is what you can expect from this video. Number one, what is a credit score? 2, why are credit scores important? 3, the basics of checking your credit score. 4, what are the things that can positively impact your credit score? And 5, what are the things that can negatively impact your credit score? So maybe you are somebody that is looking to purchase their first home, or perhaps you have a bad credit score and you are looking to make an improvement in that, then this is the video for you. We're going to go into all of the details about credit scores so that you get all the information that you need to make the changes that you want to see. So let's answer that first question then. What is a credit score? So a credit score is a number that will be attached to you personally, and it is a way of lenders and like mortgage providers and people like this who are going to be lending you money to assess your risk. So what risk is there that you won't pay this money back or that you'll be late on your payments? So the better that number is, the higher that number is, the more reliable you are as a borrower. So in order to provide these scores, there are things called credit reference agencies. And there are 3 main credit reference agencies here in the UK. You have Experian, who provides a score between 0 to 999. There's Equifax, whose scores go from 0 up to 700. And there's Transunion, whose scores go up to 710. Now, each of these companies has their own record of you and your reliability and your history as a borrower of money, okay? So they will have information about when you borrowed money, how much you owe, how you have been in terms of paying that money back. Have you had late payments? Are there any things that maybe you have done in the past, or, like things like CCJs that could impact on your reliability or your ability to pay money back? So they aren't standalone. They don't interact with each other. So if one's bad, that doesn't necessarily mean that the other ones are bad too. So it's important to keep an eye on all of them and see what your score is and make any improvements that you need to improve the scores for those particular credit reference agencies. It's also important to remember that the credit score is just a number. It's not the be-all and end-all of what you need to think about when it comes to improving your ability to get things like credit in the future. You need to look at the actual credit report itself. What sort of things are on there? So this is the information that goes into producing your credit score. It will be all the information about when you made late payments, what company it was to, how many times this happened, and the dates on which it happened. So it's more important to address the things on the report itself rather than becoming overly focused on the credit score. If you focus on the actual items and getting these things removed from your credit report, then you will automatically see an improvement in your credit score. So it's just a general measure, a kind of like a snapshot of how you are doing in terms of credit and what is your reliability and what is the risk level for that lender. So why are credit scores important? Now, for companies that might want to lend you money, so these could be credit card companies, loans providers, mortgage providers, these sorts of industries, they tell them what sort of risk is involved. So if they want to know, like, oh, do we lend this person money? How much can they afford? All of these sorts of things, they can use your credit report and your credit score to kind of give them an idea of how you might be at paying that money back. I guess, like in the olden days, before we had credit scores, they would have to do this history, and work this out for themselves. So then these credit reference agencies appeared and were like, we can kind of standardize this a bit and give everybody a score based on these different things. And that will make it easier for lenders to loan out this money. For you, what this means is it will impact how much money you can borrow and at what interest rate you are going to be borrowing it at. So the better your credit score, the more likely you are to be able to access more credit, and it's going to cost you less to do so. A poor credit score can mean that you have limited options around the money that you're able to access, and it's going to cost you more. It's going to be more expensive. You'll have a higher interest rate. So it's going to cost you more overall to pay it back. For a lot of people, they're interested in keeping their credit scores good because it's super important for those bigger borrowing purchases like mortgages. If you have a really expensive mortgage, so a mortgage with a high interest rate, then you are going to end up spending a whole lot more than somebody else with an equivalent amount of money borrowed, but with a lower interest rate. So it can have a big impact on your finances throughout your life. So it's really important to get that credit score in a good place before you go into those big borrowing situations. So let's look at the basics of credit scores then. So, like I said, there are 3 main credit reference agencies, and each of these will allow you to check your credit score for free. Some of them also allow you to check your full credit report for free too, but there may also be a charge on some of these platforms for this. In most instances, there are ways that you can get your credit report for free, but you may have to use a different platform to do so. So depending on the credit reference agency that you want to check your credit score for, you will have to go via a different company. You can go directly to Experian to check your credit score. If you're doing it for Equifax, you're going to need to use a company called ClearScore. Again, you can check your credit score for free here. If you want to check your score at TransUnion, then you can use Credit Karma. There are other companies that allow you to check your credit scores as well. So you can look up, say, Money Saving Expert. They have a credit score club that you can check out. And there are other platforms that will find this out for you. There's even one that will look at all of them for you too, and I will link that in the description below. So you'll need to check your scores at each of these companies and work on improving them, because you never know which particular lender is going to use which particular credit reference agency. So it's good to keep an eye on all of them. Most of these platforms will provide you some sort of feedback. Normally they use a kind of like a scale, like from red to green, and they will say, oh, your score is like low, moderately low, like somewhere in the middle, up to like excellent. And they'll give you an idea of what you might expect in terms of borrowing and give you some hints about some of the things you can do to improve them. You can also check these month on month to see how it is changing. So you might see that you do some action, maybe you get a new credit card, and then you check the following month and your credit score has dipped a little bit. Now, this is not normally something that lasts a huge amount of time, so then the month after that you might see that it goes back up again. So you can check in on this frequently and make sure that the actions that you are taking are having an impact on your credit score. So now we're going to look at what sort of things might actually be impacting your credit score and what sort of impact they're going to have. So how many points might you expect your credit score to go up or down because of these actions? Now, the information that I'm using here comes from Experian, and it was brought to my attention through Deck Camel, which is a fantastic website, and also through Mr. Moneyjar, who has a fantastic Instagram platform. So thank you to them for this information. The thing to note here is that this information, because it is based around what Experian have said, it might not be as accurate for Equifax and TransUnion, but it gives you a rough idea of the kind of proportion by which these scores might be affected by each of these actions. So I hope this is helpful for you if you're making decisions or trying to make improvements to your credit score. So let's have a look at what things can positively impact on your credit score. So the first one is to have a credit card utilization of less than 30%. So what this means is that if, say, you've got £1,000 worth of credit available to you on your credit cards or on a loan, that you are only using 30% of that, so £300. You don't use any more than that. If you keep your credit card utilization less than 30%, then Experian say that this will add 90 points to your credit score, or at least there or thereabouts. Now, the next one is to maintain a balance of £50 or less. So what this means is you can still use up to that kind of like 30% utilization, but you are paying it off every month, or you're at least not carrying more than £50 over each month. And if you do this, this should impact your score by up to 60 points. So that's going to be a plus of 60 points. So what this says is that you are using your credit card, but you're not carrying a balance, or you're at least carrying only a small balance over. This means that your credit usage is very manageable to you and you have the ability to pay it off. So that gives a nice little boost to your credit score. So the next one is no new credit applications for 6 months. So regularly making credit applications is going to have an impact on your credit score. Now, if you don't make any for 6 months, then this can add 50 points to your credit score. If you are making regular credit applications, this can kind of come across as a bit desperate, or it might mean that you have access to lots of credit in lots of different places. So this is not something that lenders particularly want to see. They want you to have some credit being used, but not lots of it. And as a reward for not making too many applications, you get that little points boost. Another one that we hear about a lot is registering to vote. This means that you have an address and they know where to find you, and just that simple act alone of just going on the government website and registering for the right to vote can add 50 points to your credit score. Right, the next one is having a credit card limit of less than £5,000. So this means that your total credit card limit across all your credit cards is less than £5,000. And if you do this, this will add 20 points to your credit score. So ideally, you want to have like some credit available to you, but you don't want to be going over the top with the amount of credit that you have access to. So this might mean doing things like reducing the amount of, your credit card limit to bring it below that £5,000. And that'll also increase your credit card utility as well. So for example, if you're only spending, say, £1,000 on your credit card each month, you're paying it off in full, then reducing your credit card limit to, say, £5,000 or a bit below will mean you have a credit card utilization of 20% and you're below that £5,000 limit. So you get that double boost. So the next one is to have a credit card that is over 5 years old. So this again will add 20 points to your score. Now, the real benefit of this is that it shows that you have like a range of credit cards. You've kept one open, you've been paying it off over different periods of time. Even if you're not necessarily using them now, keeping those old cards open somehow shows that you're a responsible borrower. And that's important. So yes, you can have newer cards. Maybe you're doing like 0% balance transfers. That's fine. But keep some of those older ones open too, so you get that little boost in your credit score. And then the final one that's can have a positive impact is paying your car insurance monthly. So this again is just like a regular payment and you are paying it off, and actually that shows that you are responsible with money, and that gives you another 20-point boost to your credit score. So it's a simple thing rather than paying it annually, although there can be a saving in there, but paying it monthly instead shows that you're responsible and that you have some sort of control over your financial situation. So what things will negatively impact on your credit score? So we'll start small first off. So having a credit card limit of less than £250. So this means that you've only got a small amount of credit available to you, and it can kind of be a bit of a warning sign, oh, maybe they can't afford more, or maybe you are not using it enough to provide enough evidence about your reliability. So if your credit card limit is less than £250, then this could reduce your credit score by 40 points. So if you're in a position to do so, it might be worth just increasing it a little bit, just so you have a bigger credit limit and you can kind of get a little points boost by upping that, so you don't get that minus 40 points. So the next one is about credit card utilization again. So this is if you are at the point where it's over 90%. Because what this says is that you have, a certain amount of credit available to you and you are using most of it. It means that you are potentially one emergency away from completely maxing that out. And that makes you quite risky and puts you in a vulnerable position. This will impact your credit score by taking 50 points off it again. So it's good to kind of keep that credit card utilization below 90, and if you can, get it below that 30% too. So the next one is more than £15,000 on credit cards. And this will again reduce your credit score by 50 points. So this is like, that's a huge amount of money, and it's all on credit cards. And again, it puts you in a kind of risky position from the point of view of the people that would be lending you money. If you can, maybe try paying off some of that debt. You can use like Debt Snowball, watch some of the videos that I have about this, and you can try and reduce the amount of credit that you are using on credit cards and the amount of debt that you have in total. So then we're getting kind of to some of the bigger ones. So this is things like missed payments. So missed or late payments can impact your credit score by removing up to 130 points. So it's important to make sure that you pay on time and you don't miss payments. If you're in a position where you think you might have to do that, it's always worth reaching out to your credit provider first and having a conversation around this. Obviously, this isn't up to, so we're not quite sure whether it'll be less than that. Maybe if it's one-off, it'll have a smaller impact. So it is definitely worth keeping an eye on this and making sure that you pay on time and all the time. The next one is a CCJ, and if you've got a CCJ against you, then this will reduce your credit score by 250 points. Once this is paid off, it will take a period of time before this comes off your credit report. So it's not necessarily something you can do a whole lot about at this point, but it's definitely something to try and avoid and to keep an eye on. And then once it's gone, you should see a pretty big improvement in your credit score. So the last big one is defaults. So this is where a credit provider decides to close your account because of missed payments. Now, a default on your account can reduce your credit score by up to 350 points. It reduces over time. So it goes after 2 years, it will go down to a reduction of 250. Then after another 2 years, it goes down to 200. And then after another 2 years after that, it should be gone completely. So these are definitely something you want to avoid because they have the biggest impact on your credit score. So there you go, that is credit scores fully explained. Now obviously it is absolutely worth you checking your credit score and looking at the full report too. If you need help in more detail about this, it is worth reaching out to the National Debt Line or to Step Change, and they can talk you through your debt situation and what you might be able to do to manage debt that is maybe out of control. If you start to get your debts under control, you should see an improvement in your credit scores. But there are little things you can do that can have a big impact on your credit score overall. So I think that if you haven't checked your credit score in a while, that is a good action for you to take today. Use one of the different platforms that I've already mentioned in this video. The links are below in the description so you can go and check that out. Thank you very much for watching today. Make sure that you come and join me over on my social media platforms. I'm on Instagram, TikTok, Facebook, Twitter. Do come join me over there, and I look forward to seeing you in the next episode. Bye!